Hey, I'm Sai. In this video, we'll clearly understand today's topic, why it matters, and break it down step by step so it's easy for everyone to follow. Today's topic is how inflation and interest rates affect your salary in real life. We'll see how prices rising can quietly reduce what your paycheck can really buy. We'll also see how interest rates change loan costs, savings returns, and job decisions. By the end, you'll be able to judge whether your salary is truly keeping up or falling behind. First, we'll define inflation in simple terms and connect it to everyday shopping. Then, we'll look at how central banks raise or cut interest rates to react to inflation. Next, we'll see how these two forces affect your employer, your salary growth, and bonuses. We'll also talk about real wages, which matter more than just the number on your payslip. Finally, we'll cover practical ways to think about raises, savings, and debt in this environment. Right now, many countries are still dealing with higher inflation than they had for years. In response, central banks in places like the US, Europe, and others have raised interest rates. Higher interest rates have made mortgages, car loans, and business loans more expensive. At the same time, some savings accounts are now paying more interest than before. Many companies are facing higher costs for materials, energy, and borrowing money. Because of this, some employers are cautious about hiring and big salary increases. So your salary today sits in the middle of three forces: prices, interest rates, and jobs. Understanding these forces helps you read news headlines in a way that connects to your life. It also helps you have clearer conversations about pay, savings, and long-term goals. Now, let's start by understanding inflation itself in the simplest possible way. Inflation means that, on average, prices of many goods and services are rising over time. Imagine a basic shopping basket with food, transport, rent, and services you use regularly. If that same basket costs more this year than last year, that difference is inflation. Inflation is usually reported as a yearly percentage change, like 3% or 8%. A 3% inflation rate means the average price level is 3% higher than a year ago.
Not all prices move the same way, but the overall average is what matters for inflation.
Some prices, like fresh food or fuel, can jump up and down more than others. Other prices, like long-term rent or subscriptions, tend to move more slowly. When inflation is low and stable, people and businesses can plan more easily. When inflation is high or unpredictable, it becomes harder to plan and feel secure. Now let's connect inflation directly to your salary and what it can buy. Your nominal salary is the number printed on your payslip before thinking about prices. Your real salary is how much actual goods and services that same salary can buy. If your salary stays the same, but prices go up, your real salary goes down. This means you can buy less food, transport, rent, and other essentials with the same money. Even if your salary rises a little, high inflation can still reduce your real income. For example, if your salary rises 4%, but inflation is 6%, you lose buying power. In that case, your real wage has effectively fallen by around 2%. This is why people sometimes feel poorer even after getting a small raise. So, when judging your pay, you always need to compare salary growth with inflation.
Next, let's see how governments and central banks try to control inflation. Most countries have a central bank that manages money supply and interest rates. Central banks often have an inflation target, such as around 2% per year. If inflation is above target, they may raise interest rates to slow down spending. Higher interest rates make borrowing more expensive for households and businesses. This can reduce demand for goods and services, which can help slow price increases. If inflation is too low or the economy is weak, central banks may cut interest rates. Lower rates make borrowing cheaper, encouraging spending and investment. Changes in interest rates move through the economy over months, not days. During this time, companies adjust hiring, pay, and investment decisions based on new costs. Now, let's define interest rates in a more personal, everyday way. An interest rate is the price you pay to borrow money or the reward you get for saving. When you take a loan or use a credit card, you usually pay interest on the amount borrowed. When you put money into a savings account or fixed deposit, you usually earn interest. Higher interest rates mean loans cost more each month for the same amount borrowed. They also mean savings accounts may pay more income, which can help savers. Lower interest rates make it cheaper to borrow, but they also reduce returns on savings. So, interest rates strongly affect your household budget and financial stress. They also influence how much money people have left after paying their debts. That remaining money affects how much they can spend at businesses where you may work. Let's connect interest rates and inflation together in one simple picture. When inflation is high, central banks often raise interest rates to cool things down. When inflation falls or the economy slows, they may start cutting rates again. This back and forth is a balancing act between controlling prices and supporting jobs. If rates stay high for a long time, borrowing becomes harder for businesses. Harder borrowing can slow hiring, limit promotions, and delay salary increases. If rates are too low for too long, inflation can rise and slowly erode real wages. So both very high inflation and very high rates can hurt your salary in different ways. Healthy conditions are usually moderate inflation and stable, reasonable interest rates. In that middle zone, companies can plan, grow, and share benefits with workers more easily. Next, let's focus more closely on nominal pay versus real pay over time. Imagine your salary number rising steadily each year in a simple upward line. Now imagine a second line showing rising prices over those same years. If the salary line rises faster than the price line, your real pay is increasing. If the price line rises faster than your salary line, your real pay is shrinking. Sometimes the lines are close together, meaning your real pay is almost flat. Other times there can be gaps where you either gain or lose buying power quickly. Periods of high inflation can produce sudden downward moves in real wages. Periods of low inflation and strong growth can lift real wages for many workers. This is why economists often focus on real wage growth as a key well-being indicator.
Now think about how employers set salaries while facing their own rising costs. A business pays for wages, rent, energy, materials, taxes, and loans. When inflation rises, many of these costs increase at the same time. If interest rates go up, the cost of the business's loans also increases. Higher costs can push businesses to raise their own prices to stay profitable. But if customers cut back spending, businesses may fear losing sales. In that case, they might slow hiring, reduce bonuses, or limit pay increases. Profitable, cash-strong firms may still raise pay to keep and attract good workers. Weaker firms may struggle to match inflation with salary increases. So your pay path depends both on the macro environment and your employer's situation. Let's look at how inflation and rates affect different types of workers differently. Workers with strong bargaining power may negotiate raises closer to or above inflation. Workers in weaker positions may see small raises that don't keep up with prices. Unionized sectors sometimes link pay adjustments to inflation measures. Some contracts include automatic cost of living adjustments based on inflation data. Freelancers and self-employed people may adjust their prices, but demand can limit them. Public sector salaries may change more slowly, often after policy decisions. Remote workers may feel inflation differently depending on where they live.
Overall, the same inflation rate can feel very different depending on your job and location. Your sense of progress often depends on how your personal pay compares to your local prices. Now let's include taxes, which also affect your real take-home pay. Your gross salary is the total before taxes and social contributions. Your net salary is what you actually receive in your bank account. If your nominal salary rises, but you move into a higher tax bracket, your net gain may shrink. Inflation can push nominal salaries up, sometimes causing bracket creep in some systems. In that case, more of your nominal raise could be taxed away. Some governments adjust tax brackets to reduce this effect, but not always perfectly. So to judge your real situation, you need to look at net pay versus prices, not just gross. Benefits like health coverage, pensions, or subsidies also matter for your total package. If benefits weaken while inflation rises, your overall real compensation can fall. Let's now consider how inflation and rates affect your savings and debts alongside salary. If you hold cash savings with low interest rates during high inflation, its real value falls. Your money may buy less each year, even if the number stays the same. On the other hand, fixed-rate debt can become easier to bear if your salary and prices rise. You repay with cheaper money, as long as your income keeps up and you can meet payments. When interest rates rise, new loans become more expensive, but old fixed-rate loans stay the same. Variable-rate loans, like some mortgages and credit cards, can get more costly quickly. If loan payments rise faster than your salary, your budget can feel very tight. In that situation, even a salary that matches inflation may not feel like enough. Thinking about salary, savings, and debt together gives a fuller picture of your real position.
Next, let's see how inflation and rates can influence career and job switch decisions. In periods of strong growth and moderate inflation, job openings may be more plentiful. Companies then compete for talent, sometimes offering bigger raises to attract people. In periods of high rates and slow growth, job openings can shrink. Companies may focus more on cost control than aggressive hiring. Switching jobs might still raise your salary, but risks can feel higher in uncertain times. Remote and global hiring trends can also shift pay differences between locations. In high inflation places, some workers look for jobs paid in stronger or more stable currencies. Understanding these forces helps you see your career decisions in a broader context. You are not just negotiating with one employer, you are operating inside a wider economic climate. Let's now calmly recap the key ideas about inflation, interest rates, and your salary. Inflation is the general rise in prices, and it directly affects what your salary can buy. Your real income depends on how fast your pay grows compared with how fast prices grow. Interest rates are the price of borrowing and the reward for saving. Central banks move interest rates mainly to control inflation and support stable growth. High inflation without matching raises quietly reduces your real standard of living. High interest rates can slow business activity, affecting hiring, promotions, and pay growth. Your employer's costs, profits, and access to credit all influence your salary path. Taxes and benefits also shape whether your net position is improving or weakening. Savings, debts, and monthly payments change how inflation and rates feel in your daily life. Different workers experience the same inflation rate in very different ways. Your sector, skills, contract type, and location all influence your pay outcomes. Understanding these links helps you read economic news with more personal insight. It also helps you interpret raises, job offers, and career moves more clearly. You cannot control inflation or central bank decisions, but you can understand their impact. With that understanding, your salary is not just a number, but part of a bigger story. That story connects prices, interest rates, employment, taxes, and your own choices.
Thinking in terms of real income rather than just nominal amounts makes that story clearer. Use this lens whenever you look at a new salary, promotion, or financial commitment. Do you think this will matter more in the future? Comment below.